Another Jobs Friday with no government data due to the shutdown. UMich, though, coming in very low, near the lowest level ever since the 1970s, as worries begin to build about the consumer and the macro environment overall. Our next guest says we may be close to the worst jobs market in 50 years outside of recession. Let's bring in Goldman Sachs chief economist Jan Hatzius to talk about what data he's watching and where he sees the market going from here. Jan, it's good to see you. Happy Friday.
Very good to see you as well.
Is that a fair way to frame your view on jobs right now?
Outside of recession, I think that's probably right. Certainly, I mean, it really depends on what you look at. If you look at the confidence numbers, for example, the expected change in the unemployment rate in the University of Michigan numbers, that's a really low reading that you really don't see outside of recession. Then, of course, other indicators about the current level of employment or unemployment, those look much, much better. So you do have to triangulate between a lot of different indicators. But since we're not getting updates on some of these harder indicators, it's hard not to put more weight on the timely stuff. And the timely stuff, which is maybe also more volatile, but it is looking weak. It's looking very weak.
Right. You do have to work with what you have. Revelio sees 9K loss on jobs. Indeed, job openings weren't so good. I mean, even though they're all we have, are they reliable in full?
Well, I think on employment growth, we do have, ADP, we have the Revelio numbers, we have, otherwise not really a lot. It looks like employment growth is fairly close to zero. So maybe it's sort of stabilized where it was in the official numbers pre-shutdown, but it hasn't really gotten better. And I do think that openings and hiring are still weak and potentially still getting weaker because the link up and Indeed numbers have continued to trend down. What we don't know is what's happening on the layoff side. Claims look good, continue to look good, and we have pretty good information on that.
You're guessing 228-ish, yeah?
Yeah, that's right. And it's been in that range, sort of 220s or so. But then you have the warn notices that firms have to file with states when they lay off a certain number of people. That's been inching higher. And then, of course, you have the layoff announcements that are summarized in the challenger measure, and those look very weak. So that's not actual layoffs that can summarize a bunch of different headlines, but there's at least enough there to make you nervous.
Right. So are you having to take a second look at your GDP tracker?
Well, GDP looks like it's doing kind of okay. Of course, we don't really have any updates for the third quarter. We're 3.6%, so it looks like another strong one. GDP is very distorted by front-loading effects and changes in inventories and so forth. So I would, even more than normally, put weight on the labor market numbers as a measure of how the economy is doing at the moment. Current quarter GDP, you have to be pretty careful with. And, of course, that's all the more true right now.
Right. Challenger's another good example of a number that was an outlier for October, worst October in some 20 years. Aside from whatever people say about its own reliability and its noise, is it making you pull forward your expectation for any impact from technology on labor?
It is at least tempting to build that in a little bit more. And I think the risks to our view, which have always been significant impact from AI on growth, very sizable impact, and a meaningful impact on the labor market, but pretty backloaded. I think the risks are that it is happening somewhat more quickly. Now, I think most of what we're seeing at the moment is not directly related to AI. It's an extension of the, sort of echo from the pandemic and the low hiring environment, and maybe we're getting towards the end of how much companies can do from a low hiring perspective, and therefore they're having to rely somewhat more on layoffs. But it at least raises some questions about whether technology has a bigger role.
Right. So then looking at the 10-year, should we be surprised that it's managed to hold 4? What is the threat of inflation right now?
Well, I think the inflation numbers have generally been relatively good. I mean, recognizing that we're seeing pass-through from tariffs into inflation, and that is that's occurring, and that has somewhat further to go. I'm in a similar place as Chair Powell, who said 50 to 60 basis points of pass-through so far, and we're expecting another maybe 40 basis points or so from here. That number has come down a little bit recently because of the U.S.-China trade agreement, but that's a factor, but it's a known factor, and I think it's a factor that is probably more like a price level increase. The non-tariff related news from the inflation numbers has been pretty encouraging. And, if you subtract 50 or 60 basis points from 2.8% or so on core PCE, that gets you down to 2.2, 2.3. And then there's probably some impact from distortions in the way they measure financial services inflation. They basically use stock prices to some degree. And then, it's always a little dangerous to say, if you take out this and take out this, then you get to some really good number. But it does get you pretty close to 2. So bottom line, labor market news has been more concerning. The inflation news has been, I think, generally encouraging. So I'm still comfortable with the idea that the Fed delivers a cut at the December meeting, despite the, very targeted injection of uncertainty that we saw in Chair Powell's press conference.
Yeah. And we'll talk maybe in future dates about Powell's influence going into these final months, and certainly the potential for tariff refunds, which I know you wrote about this week as well. Jan, thanks as always. Good to see you, even without the jobs number.